All right, let's go ahead and get started. Today is Wednesday, January 31st. This is the section 301, 2 p.m. section. This class is being recorded for YouTube. As we get started today is the first day we are taking attendance. This is the attendance sheet. I'll be passing this out in every class we're taking attendance that is live. Make sure you sign your name, nobody else's, on the attendance sheet. This is your record of whether or not you have been here. I also put in the announcements this morning a link to the attendance tracker. Basically, based on these attendance sheets, if you're here, it'll be blank. If you're absent, it'll say absent. That's an unexcused absence. If you're excused, it'll switch to excused. That's an excused absence. 2 unexcused absences can no longer opt out of the final exam. Okay, so you'll be able to see that as you're going through. But this is the record. If you don't sign this, you weren't here. And I won't be able to change this in the future. We'll start this over here. Questions about attendance? I know one person that's in here that's on the wait list. Go ahead and sign your name at the bottom, just so we know you're here. Keep track of that. All right, so that is one thing. The second is under people. Today we're going to start the Bloomberg Trading Challenge at the end of the class, which means you have to be on a team. So this is section 301. These were the teams at the beginning of the class, teams 1 through team 6. No team is full, which means technically anybody could join any one of these teams because you have up to 8 people. How many people by show of hands are not on a team? Okay, you have between now and about 45 minutes from now to put yourself on a team. So just drag yourself to any open team in this section. You have to be on a team in this section. If you're in 301, team section you're registered for. I'd suggest starting with team 3 because they have the fewest amount of people, and then team 1. But just put yourself on team 1 or team 3, okay? And then we'll talk more about the trading competition near the end of the class. What we're going to spend most of our time on today is homework 2, which is basically getting into the EIC content, okay? So we'll start with our slide deck. Skip a few slides, which we'll come back to on Monday. But I want to talk about the EIC framework. All right, EIC is a framework. E stands for economy, I industry, C company. It was developed on Wall Street to basically help understand the external environment and how industries and companies are tied to that external environment. As we talked about last class, about half your performance is your industry. So we need to know how attractive or unattractive the industry is, why it is, and whether or not that's going to change over time. That'll be part of your next homework assignment. By the way, I'm not talking about homework 1 as the screenshot. I assume everybody figured that one out. Anybody have any trouble with homework 1? Okay, good. All right. So I'll start with the idea of E, which is the economy, macroeconomic point of view. The goal here is to answer 2 questions. Right? Question 1, which is how attractive or unattractive is the economy? That's the economic analysis of this. And the whole idea is that if the economy is better, a rising tide should rise all boats. If the economy is worse, rising tide should hurt all boats, or falling tide should hurt all boats. So is the economy getting better or worse? And how's that? Second question, how does this company or industry tie back to the economy? Okay, so 2 examples. Let's say we were doing Southwest or Delta Airlines, okay? One of the macroeconomic indicators we might be tracking is oil prices. Why are oil prices important to an airline? Yeah. Large part of their cost. You have a sense of how much? 20 to 25% of an airline's cost is fuel. So an airline's going to make a lot less money if oil is $100 a barrel than if oil is $70 a barrel. Okay, so that's the point. Like, airline stocks are tied to oil prices. And when oil goes up, airlines go down. Just general rule of thumb. Back to the macroeconomic indicators. Now, we're going to talk today about Netflix. Do you think Netflix is as tied, and streaming companies, to oil prices as an airline? No. So the sensitivity might be different. That's the second question. Some industries are going to matter more than others, and sometimes the economic indicators might be different. But that's what we're trying to address in the E section. Earlier today, and I don't know if it's a top headline in Bloomberg, in our last class, TOP. Might have moved down the list. Yeah, it did. All right, so two stories. The first story basically says the Fed just announced they're holding interest rates steady, and they're getting closer to cutting them in the future. All right, how is that story probably going to affect the markets from a macroeconomic standpoint? Yeah. I'm sorry? Why is it going to have a positive impact? Walk me through. So lower discount rates, lower cost of capital, which then means what? Why? Yeah. So the cash flows that we're discounting at a lower rate, which means those cash flows are more valuable. Yes?
I would say it depends on what the expectations were that we made.
Depends on expectations, but generally, it should have hopefully a positive effect if interest rates start coming down. And that would be the economic side of the story. And that's, again, a macroeconomic issue. But that's the point. Some industries more affected than others. The story this morning was on a bank that reported earnings, mid-sized bank, I forgot which one it was, but it basically said that they really blew their earnings estimates in a negative way. And they were having all sorts of problems with loans and the yield curve. And basically the fear is that means, as the other regional banks talk about this, high interest rates are actually not good for banks right now in the short term. And so basically they're saying that that's putting further pressure on the Fed to cut rates because they don't want to do another bank bailout. So I'm just saying, a couple of stories. The general trend is towards lower interest rates. Obviously expectations play a role in this, but the point is those are economic factors that should be helping the stock market, right? Matter of fact, what is it right now? SPX. Just kind of seeing where we are. Actually, the market's down 36 points. But we expect it to go up over time. All right. Two screens. I know you're doing the Bloomberg certification, and that has the economic module in it, but two screens that I'll pull out and highlight. One, ECFC. Stands for Economic Forecast. It'll default to a country, in this case the US, but you can look up any country in the world. And the idea is, just as the analysts are tracking earnings, the economists are tracking economic data. So this is economic data for the US, historical data, and in white, forecast data. Okay, it starts with GDP. So for example, last year, US GDP, 2.5%. This year, it's expected to be 1.5%. And next year, 1.7%. So this is the idea of the soft landing. We're not expected to have a recession, although there is a 45% probability recession today, right? But generally, the market's not expecting a recession today. They are expecting, again, some small GDP growth, 1.5%. Now, if you look at this, you might say, gee, where'd this number come from? Any number in Bloomberg you can click through. Just as the sell-side analysts are predicting earnings, these 82 economists are uploading their economic guesses for the U.S. to Bloomberg. And Bloomberg takes a wisdom of the crowd approach, so it's averaging the 82 guesses. The average guess today is for GDP to go up 1.5%. It's also the median. The high today is 3.1%, the low is 0, and the mean is 1.5%. Okay? But that's essentially a forecast of GDP. Now, what else is the market forecasting? Scroll down and see. Consumer prices, aka inflation. They're expecting inflation next year at 2.7% and then 2.3% thereafter. So that's the whole idea why Fed could potentially lower rates, because inflation is expected to now be under control. And as a matter of fact, if you kind of think about it at a high level, we have positive economic growth, 2%-ish, 1.5%, 2%. You have lowering to normal inflation. You have lowering interest rates. And you have pretty low unemployment. Matter of fact, unemployment down here, 4%. Anything under 5 in the U.S. is considered full employment. I mean, you may not like the job, but if you want a job, you can get a job, okay? So we're seeing good unemployment. We're seeing good inflation. We're seeing lowering interest rates. I mean, that's a recipe for a better economy, right? And that should be helping stocks and stocks market in general. Obviously, this could be different for different countries, and you can see some other information that they're forecasting, but here's just some economic data, right? So here's what I want to understand. Let's say we're doing Netflix. Take all this information. Does this matter to Netflix? This kind of generally positive economic news. Is this going to help Netflix and the streaming industry? Why? Yeah.
I would say yes, it would help them because it's not like Netflix is a necessity. So if there's positive outlooks, they'll have more, people think they'll have more disposable income.
Great. So this is how I want you to start thinking about your 500-word paper. You got the economic data, which you're referencing, sensor 2, how's it tied to the industry and company that I'm looking at. Okay? Your homework 2 is on Lockheed Martin, which is on the defense and aerospace industry. Okay? And part of it's going to be the E for the defense and aerospace industry. We'll use Netflix as kind of a working example here, but nonetheless, I want you to do it on defense and aerospace for homework 2. Individual assignment is already up there. So what you're going to do, just a preview of where we're going today. Where is my browser? Under assignments, homework 2, due Monday, 10 a.m. EIC, the company is Lockheed Martin, LMT US Equity, based in Bethesda, Maryland. They are a big defense and aerospace giant. You're going to use, and I'm telling you what to use, BICS, Best Fit Algo, Country of Domicile, which means they're a U.S. company, so it's going to be U.S. peers. That's the peer set I want you to get for your assignment. Okay? You're going to take 2 screenshots, which we're going to talk about in a minute, and you're going to write a minimum 500-word paper. If you don't turn in the screenshots, you get a 0 on the assignment. If you don't do the 500-word paper, you get a 0 on the assignment. Those are minimum requirements. You'll also be referencing the data in the paper to the screenshots that you turn in. Second, what are you going to put in there, your paper? In the economy, it's what I just said. You're going to talk about how that economic data affects the defense and aerospace industry and Lockheed Martin. Second, for the industry, you're going to talk about the industry spread and explain the industry spread today using Porter's 5 forces. Third, you're going to talk about whether those 5 forces are going to change over the next 5 years because you're going to forecast an industry spread and explain that 5 years from today. Next, you're going to do company, which is competitive advantage, and you're going to talk about whether or not Lockheed Martin has or does not have a competitive advantage. And third, final part, whether or not Lockheed Martin's competitive advantage will change in 5 years. That's the paper that you're going to be writing. That's the company that you're going to be analyzing. Okay? So again, let's talk about how to do that in the context of using Netflix as a working example. So number 1, what's going on with the economic indicators? Do you think, second part of that is how tied is a company or industry to the changes in the economy? So we just said that the streaming business and Netflix probably tied to consumer prices and sort of the economic issues. Do you think it's the same impact for defense contractors? Do you think they are as tied to the economy as a company like a Netflix? I'm seeing some shaking heads. Why not?
It's like defense is very important to the country and what they're going to spend on that.
So defense is important, particularly the U.S. So unless there's a war, there's a probability we could get into a war, but let's assume we don't get into a war, like defense spending, we're going to spend. Like if there's a recession, we're still going to spend on defense. And unless there's a war, we might spend a little bit more, a little bit less. Matter of fact, what's ironic is what the Republicans and Democrats are going to shut down the government for and argue over the next 45 days is plus or minus like 1%. That's it. They're arguing over a percentage point of how much we're going to spend. We're going to spend $700 billion plus or minus a little bit, and they're going to fight over that. But we're still going to spend $700 billion, which is about 3% of GDP. It's actually lower than it used to be. The U.S. used to spend in the Reagan and Clinton administrations 6% of GDP. Now we're spending 3% of GDP. We're actually not spending nearly as much as we used to. So the point of the story is that the government tends to, regardless of the time, spend on security, and defense budgets are not as tied to the economy. So there's a little hint as you try to do this assignment, if you don't know a lot about this industry. The other thing that makes them a little less economically sensitive is the nature of their contracts. They'll sign a contract for a missile, radar system, cybersecurity, ship, whatever. These contracts are like 5 and 10 year contracts. So what you'll find in the defense and aerospace industry is they call it backlog. right? So I'll sign a 10-year contract. Well, government's going to honor that 10-year contract. So year to year, changes in the budget don't actually affect the contracts. And so these companies become fairly stable over time, okay? Because they have a big backlog for future contracts which are already committed to, okay? So a couple of hints about the industry as you do your analysis. But that being said, tied to the industry, what we're going to do for simplicity this semester, we actually would probably do a more detailed analysis, but I'm going to keep it simple, is we're going to start with the concept of beta to be a proxy for economic sensitivity. Okay? What does it mean if a company has a beta of 1.5? Yep. So how does 1.5 work? What happens? Market goes up 1%, what happens to the company or industry? Yep. And the market goes down 1%, what happens to the company or industry? So a beta of 1.5 means you're going up a lot faster and down a lot faster than the market. What does that suggest about economic sensitivity? Probably more economically sensitive. Same thing, beta 0.5. Market goes up 1%, you go up 0.5%. Market goes down 1%, you tend to go down 0.5%. That suggests less economic sensitivity. Now we're going to be careful because the past doesn't always repeat itself, okay? But nonetheless, we're trying to get a proxy. So two things. Let's say we're going to do Netflix. Oh, sorry, before I do the beta of Netflix, I forgot one other screen to show you. Economic, ECSU. We'll come back to Netflix. ECSU. This is called the Economic Surprise Index. Bloomberg started this back in the 2008-2009 recession tied to the housing market. And the whole idea is this. On the left, they track 42 economic indicators for the U.S. economy, or any economy. They put them into 6 buckets, okay, 6 categories. And they have an overall index for each of the categories and one for all 42 metrics, okay? Over here, you can kind of see the buckets. So one of the buckets is called housing. So for example, pending home sales, which were announced on January 26th, were expected to come in much lower than they actually came in. The market actually underestimated housing sales by 4.83 percentage points, came in at about 8.3%, was probably expected to come in closer to 3.5. Okay? So that trading day before the announcement and after the announcement, what happened to the market? By the end of the trading day, the market started going up, better than expected housing sales. So it's not just is the market getting better, somebody mentioned expectations, is it doing better than expectations? And what this surprise index shows you is this white line is the S&P 500 index. This orange line is what they call the surprise index. Positive surprises green, negative surprises are red. Generally, when we get positive economic news, better than expected, market goes up. And we get negative surprises, market goes down. And the correlation is not 1-to-1, but it's pretty strongly correlated over the last 14 years. That's what this chart shows you. Okay? So let's look at today. Of the 6 housing indicators, 5 of 6 are surprising based on recent data versus where people thought. Industrial sectors, which is orders, production, inventory, etc., capital spending. Generally, you can see some surprises and negative surprises. Labor, which includes unemployment, is coming better than expected. Personal spending, basically what we're spending on retail sales. U.S. consumer was pretty strong in the holiday 2023 quarter. We spent a lot more than expected. And these are basically leading indicators, basically sentiment. How do businesses and consumers feel about the future? Okay? When you look at these 6 buckets, 4 of the 6 buckets have had a lot of surprises. What the data says is, based on what was expected in the economy, housing's done a lot better than expected recently, in the last month. Industrial production's better than expected the last month. Labor's been a whole lot better than expected in the last month. Personal spending, a little bit worse. Retail spending, a lot better. Sentiment, we still think the economy sucks. Okay? So I'm just saying, we repeat the data. Like, We got positive GDP, we got low inflation, we got lowering interest rates, we got low unemployment, and everybody thinks the world's going to hell in a handbasket and the economy is awful. Okay? I can't explain this except for the news. The news could care less about the real world and just wants to create drama. Okay? Your world sucks. Inflation's 2%. Why is it not 1? Right? So all I'm just saying is we got to be careful about, sentiment matters. But here's what's interesting. One piece of sentiment is the University of Michigan Index. This is the actual consumer confidence index, where they ask you every month, how do you feel about the future? Recently, that's been spiking up. People are starting to catch up with the good news that's happening in the economy, but nonetheless, we'll see how that tracks over the next few months. But the idea is better economic news than expected helps the market, worse doesn't hurt the market. Leading indicators here. Questions? Back to beta. So how sensitive is a company like a Netflix to this? So we're going to go to Netflix. And then from Netflix, so let's type in Netflix. We're going to type in beta. And Bloomberg will calculate a real-time 2-year beta for a company. Defaults to 2 years. And the way Bloomberg estimates the beta is it takes the last 52 weeks, 2 years by default, of performance of the company against the underlying index. So this is the weekly change in Netflix price, the weekly change in the S&P 500 index price, dot. So there's a scatter plot diagram for 2 years, draws a trend line. The slope of that line is your beta. So right now, based on the last 2 years, Netflix has a beta of 1.59. Now, Bloomberg does something called an adjusted beta as well. The adjusted beta includes a smoothing coefficient. The raw beta does not. The smoothing coefficient they use is they take 2/3 of the raw and 1/3 of 1, and that's the adjusted beta. So basically they're taking the raw beta and they're moving it 1/3 closer to the mean. Right? Now there's arguments statisticians make about why they need to do that, but what I'm going to tell you for purposes of this class, to answer your E question, I want you to use the raw beta. Right? Bloomberg by default uses the adjusted beta when it calculates WACC, just FYI. But we're going to use raw for economic sensitivity. Okay? Now, by the way, we're also going to default to 2 years. If you wanted to look at a 5-year beta, click on 5-year, it'll then just adjust for the company. So there's 5 years of data, new trend line. So 5-year, the raw beta is closer to 1. 2 years, 1.5. Okay? Now, if I wanted to, for example, regress this against the S&P 500, if I wanted to do, for example, the Morgan Stanley World Index, MXWO, here's the beta for the last 5 years of Netflix against, when I hit enter, against a world index of like 2,000 companies around the world. So you can do lots of different betas. But for you, big U.S. companies against the S&P 500, you're not going to use this screen. This is not your first screenshot. Your first screenshot is under RV for your homework. You're going to go to RV. You're going to go to the sub-tab Markets and a further sub-tab Beta. And you're going to load that, in your case, for Lockheed Martin. Right? BIC's algorithm, country of domicile. So by the way, if you're trying to do your homework, you might want to take some screenshots along the way. But this is the screen you're going to screenshot. And the whole idea here is you're, based on the screenshot, you're going to answer 2 questions. Question number 1, is this industry economically sensitive? Based on this data, is Netflix industry, these companies, is it economically sensitive? What's the answer? Yes or no, and why? Go ahead.
Why? Because their beta is greater than 1
What is the beta? You got to say it.
at 1.39.
Who's got a 1.39 beta?
Industry's weighted average.
I don't see 1.39 on this screen.
Netflix's beta is 1.59.
Okay, and what's the industry average?
1.27.
Is that what you have on your screen? Are you using BIC's best fit algorithm? Country of domicile? That's why it's important to get your screenshots right. Because if you turn in the wrong screenshot, you're gonna get penalized with the TAs. And I'm telling you what screenshot to use, so be careful. So you probably didn't have the right comp source, or you had global, not US, as your region, which will change the data.
Okay.
Okay, but based on this data, 1.27. Okay, you're getting this data now?
Yeah.
Okay, great. So what does that say? This is economically sensitive as an industry? Why? Why is this industry, this group of companies, more sensitive?
I mean, kind of based off of like she said earlier,
So what did you say earlier?
how there's more like disposable or discretionary income that's spent on streaming.
So these are tied to consumer spending,
Yes.
okay? Why else might this group of companies be more sensitive or not sensitive to the industry impacts? And think about Google. Google share price is down like $9 today. Why? They just reported earnings. What spooked a few investors in their earnings call earlier this Friday or today? What spooked the earnings call? Monday or Tuesday, they have the earnings call. Is that ad spending came in a little soft. And Google's driven by ad spending. So the point of the story is that there's a business side to this and how much people spend in ads. And so the point is businesses probably are a little less sensitive to change in the economy on the ad spending side than consumers are to the subscription services. That being said, because even companies spend money on Google in recessions to sell their products. Spend a little less, but they still spend. I cancel my Netflix subscription because I can't afford it. Okay? Companies are still going to spend, big companies, because they don't have a choice. At least that's been the historical behavior. Yes?
So, we find like changing from local to
Make sure you have whole company location domicile. You're not doing Netflix, I don't care. You're doing Lockheed Martin. Yeah. All right, but here's the first part. You're going to explain the industry beta, and then you're going to go to your company. Netflix is 1.59, industry is 1.27. Now these are equity betas. They're not like unlevering the equity to get an asset beta and relevering. They're just taking a weighted average of these. But the point is, Netflix is more sensitive at 1.59. Why? Why is Netflix more sensitive than the average company in this list? Yeah. Yeah.
Those companies such as Uber or more are not that economically sensitive because you still need to get around if you don't have a car and you aren't used to using taxis anymore.
Yeah. So Uber and Alphabet, as competitors, as you just said, just here in the video, are less sensitive because of the nature of the driving business as well as the ad business, which we also talked about the business side, which makes them a little less sensitive than a consumer-driven business like Netflix. So that's what I'm saying. Part of the paper, data write-up. Industry economically sensitive, why or why not? Company relative to industry, more or less sensitive than the industry, why or why not? Okay, there's a paragraph waiting to be written there. Using data. You're going to quickly find 500 words won't take too long. Questions about the E? Now we move to the I. And part of the I might also help you answer the E. The I is the industry. Screenshot number 2. You're going to go to custom, and you're going to load the same template that you did for homework 1. Bonus of doing homework 1. This is the industry spread. And what you're going to do for the I, when it loads, is the industry ROIC is 21.86%. The WACC is 10.35%. This is a very value-creating, attractive industry with a spread of about 10.5 points. You're going to explain why this spread is so good using 5 forces. Okay, so as part of the I, you're going to do a 5 forces analysis, which you should have done in a previous class. Why can't I get back to my PowerPoint? Buyer power, supplier power, barriers to entry and exit, rivalry, substitutes. You're going to talk about all 5 of those forces. And the whole idea is you're going to use that model to explain the spread that you see. So why does Netflix and the streaming companies have such a positive spread? as an industry. Now, I want to be really clear about this because there's been some confusion from previous semesters where there's some idiot professor who told them to do a 5 forces on a company. No. 5 forces is on the industry. Okay? So it's not the 5 forces on Netflix. It's the 5 forces on Netflix's industry. The C is the company analysis on Netflix. Okay? So you don't do a 5 forces on a company. Right? Whoever told you to do that, they don't know what they're talking about. They didn't read Michael Porter. Right? So the industry analysis. So be careful as you write your papers. So back to this. Why? Which of those forces are favorable that suggest better spreads? Is it the buyers? We don't have a lot of power? Are the barriers to entry really high? Is the rivalry low? What is it? Yeah, go ahead.
The barriers to entry are pretty high,
Why are the barriers high?
because like to start a streaming service, you need access to a lot of content.
So you guys spend a lot of money to buy that content. It gets really expensive. How much does, as a proxy, how much does Netflix spend on original content per year? Does anybody know? Approximately $10 billion per year on content. All those shows, the true crime shows, the stupid romantic comedies, all that costs money. Okay, they got hundreds of them they produce every year. Most of them are pretty bad, but there's a lot of bad stuff you can see. Okay. Second part, I told this in previous classes. There's 2 shows I've been watching recently that I really like. One is called The Bear, which is on Hulu. Best show on television right now, as far as I'm concerned. The other one I really like is called Reacher, which is on Amazon Prime Video. Okay? So here's the point. Let's say that you're like, oh, Professor Buffet, you talking about this, maybe I want to check out The Bear. If you don't have Hulu, you can't watch that show. If you don't have Amazon Prime, you can't watch Reacher. Okay? If you want to watch a Marvel movie, you need Disney Plus. Does that affect this industry spread? Which of the forces am I talking about here? Is that part of the barriers to entry? Does anybody subscribe to something called Tubi TV or Fubu TV or one of those stupid services? You know why I call them stupid services? Because you're going to be watching The Munsters, or you're going to be watching Gilligan's Island, or content that nobody cares about anymore, because all the expensive content that you like has been locked up. Those are barriers to entry. That's why it's so hard right now to start another streaming service, because basically, what are you going to stream? We've now had these walled gardens. That's why you had to have multiple streaming services to get to the content that you want to see. That's been favorable to the industry. As a matter of fact, it's reduced some of the rivalry, because that's the point. We're not fighting over some content because you don't have it. I have it. And we're going to not even fight on low prices. They're all raising prices because you want that content, you got to go to that service. And they're almost like mini monopolies. It's oligopolistic competition. The other thing is the rivalry has actually reduced your buyer power, because it goes back to, if you want to see this content, you got to buy for the streaming service. Yes, you can cut the streaming service at the end of the month, but you want the service back if you're going to see that content again. And now they're moving live TV to that. Look at the Peacock with the NFL. You want to see NFL games? Increasingly, you got to have Peacock to see it. And so that's the point. Like, this is actually taking away your buyer power. So when you start to explain why these industries are making 21% ROICs, this is the point of the 5 forces. Matter of fact, suppliers, Hollywood just went on strike over all this stuff because they weren't getting paid by the content providers. And they didn't get that great a deal coming out of the strike, right? So the supplier power has not been that high to these content providers. So, and by the way, they've also vertically integrated, because Disney produces its own movies for Disney Plus. Okay, so that's the other thing. Netflix is creating its own content for Netflix. Amazon Prime for Amazon Prime. So they're building these vertically integrated walled gardens, which has reduced the buyer power and the supplier power. So what I'm telling you is you have to explain, using real stuff, what you see for the 5 forces today and the spreads you see. In this case, for Lockheed Martin in the defense and aerospace industry. That's homework 2. Easy peasy? Yes, questions?
What, I've seen some stuff, so like on Netflix, they've leased stuff out to, I mean, not on HBO, they've leased stuff out to Netflix. They're available on platforms. What would that affect? Like,
You tell me. Do you think that changes buyer power? Do you think that's a barrier to entry, reducing a barrier to entry, or
Yeah.
increasing a barrier to entry? Like, put it into the bucket. and as I said, with the TAs and to some degree, I am grading this stuff, I'm less concerned that you get it in the right bucket, that you identify the issue and tie it to a potential bucket. Because the whole point is, I want you to explain what you see. I don't want you to just regurgitate numbers. Anybody can basically say, industry spread 10.5%, ROIC 22, cost of capital 10.5, let me move on. That doesn't show me you know anything other than how to read. Okay? This is what I mean by, I want you to tell me what it means. That's why I'm asking for the papers. You gotta explain what you see. Sorry, you gotta go underneath that. Okay. All right. Next part of the I. What's gonna happen in 5 years? What is gonna happen to this spread 5 years from today? Is it still gonna be a 10.5 point spread with a 22% industry ROIC, or is that gonna change? So the way you're gonna predict that is you're gonna talk about the 5 forces in 5 years. Because here's the idea. If the 5 forces are about the same in 5 years, the spread's gonna be about the same. If the 5 forces go more favorable in 5 years, then the spread's gonna improve. And if the 5 forces get worse in 5 years, then the spread's gonna go down. So you're essentially gonna make a prediction about what the next 5 years is gonna be. Yes?
How like creative can we be?
How what?
Creative can we be? Can we like, I don't know, say that in the future like companies will merge and this is gonna change this or?
As long as it's based on something that's realistic to the real world, fine. Like, I don't want you to like sling a bunch of BS, right? That's not what this class is about. And that's why I want you to use data sources to help support some of those conclusions. But yeah, if you believe that there's gonna be a bunch of M&A, which is gonna further take away choice and essentially help the industry more, same thing, they're all adding commercials now and raising their prices. Like, is that gonna, low buyer power continue to be higher margins? Like, tie it to that and the explanation. But the same thing I'll tell you about Netflix, and you can see this in the real world today. This applies to grading. If you go to Netflix, so this is screenshot number 2, by the way, which you're gonna do it for Lockheed Martin, ANR. These sell-side analysts are trying to do the exact same thing we are, okay? You go work on Wall Street, you're working for JP Morgan, the team covering Netflix in this industry, they're trying to answer this exact same question. By the way, look at those buy-sell holds. There's disagreement. So that's the next thing. We can't grade you on whether or not we agree with you. You could have 2 people in this room. One says this industry is going to get better. Another person says this industry is going to get worse. Because we're dealing with the future, you both could be right, and you could both get full credit. But you got to have a rationale that's a business rationale that explains that. Does that make sense?
Yeah.
Okay. C, competitive advantage. Based on this data, RV custom spread, does Netflix have currently in this industry competitive advantage? Yes or no? Given this data, I'm reloading, does Netflix have competitive advantage? Yes or no, why or why not? Yeah.
No, because their spread between their WACC of 11.22 and their ROIC of 16.32, which is about 5%, is less than the industry spread of ROIC 21.86 and WACC of 10.35, which is about 11%.
Yeah. And so the 11% spread is much higher as an industry than Netflix 5% spread. So, they're creating value, not as much as the industry, because unfortunately they're in there with Google. And Google's doing really well. So here's the point. Why? Why is Netflix underperforming the industry? And will this change in 5 years? Will they still be underperforming the industry and spread in 5 years? Will Netflix catch up and be average? Or will Netflix surge and become above average? That's competition. So EIC. E, beta, sensitivity for the industry economics and how companies sense the industry. I, 5 forces today, 5 forces in 5 years, explain the spread. C, explain competitive advantage, relative spread, and whether that will change in 5 years and why. Okay, that's your assignment. You're just going to be doing it on Lockheed Martin and Defense and Aerospace, which I know you know a lot about. Yes?
We're all probably gonna have like varying answers. So like, is there like a correct? Is there like anything correct that you're accepting for?
Well, the The short version is how we define correct. So in this class, and this is just a good example of an assignment, you're dealing with the real world, and we're dealing with the future. So correct can't mean, when we're dealing with the future, like, there's no perfect answer, right? But there's a process. And so what I expect you to do is I expect you to follow the process. I expect you to use real data, and I expect you to explain your answers so that there's judgment and context for how you're coming up with the answer that's academic in some way. Okay? And that's what I said, you can have different points of view. There's real difference in point of opinion on what's going to happen in Netflix over the next 5 years by the real world. So I can't expect unanimity in answers here. But if you're saying it's a sell, or you're saying it's a terrible spread, it's going to get worse, why are these forces changing? What would be a rationale for that? And it's got to be a realistic rationale. Does that make sense? What I don't want you to do is just plug and chug. You can't just state numbers in this class. Okay? It's not what this class is about. Anybody can solve the equation. Right? Can you explain why you put the data in and what it means? That's a lot of what we're going to be practicing on this semester. And trust me, you're a junior. By the end of the semester, you're going to know about a lot of companies and a lot of process. And if you're interviewing, you will differentiate yourself versus other people. Because other college students will have no clue how to have answers to these questions that you'll have. Because when you'll get a case that I'm sitting there at one of the investment banks and ask you to talk about a company, you got a process to walk it through. Okay? They have no idea how to answer these questions. So I'm just telling you, this will benefit you in the real world, not just in this class. Yes? Aha. So I was waiting for that panic question, the oh shit. Oh, sorry, this is on video. OS. Sorry, I can't delete that out. But basically, I don't know anything about defense and aerospace. I don't even know anything about Netflix. I just have a subscription, right? And I can't steal it anymore from my parents. Like, I don't know anymore. How do I answer these questions? So here is my suggestion. So when you're on a company in Bloomberg, type BICO, B-I-C-O. Stands for Bloomberg Intelligence on a Company. What Bloomberg does is they hire ex-sell-side analysts, and these are the two that used to work for the banks in this industry, and their entire life is to curate what all the analysts are saying and collapse it into a one-page overview. Okay? Because basically, if you work at BlackRock, you probably got ADD. Like, I got so many companies in my portfolio, I don't have a lot of time to read like 40-page opinions, which, by the way, you, the undergrad, hired for them, are going to write these 40 pages, but they're going to want the executive summaries. And so that's the point. Like, if I'm a trader, if I'm running the firms, this is a quick summary of the most important issues that are going to affect the companies that they summarize. Okay? So that's the point. If we're trying to look at economic industry company, a lot of those issues are going to be right here. Bloomberg Intelligence. Now, this is going to be written from the perspective of Netflix. That's a company primer. Over on the left, I click on the industry. This is the industry report. So I'm trying to do the I. Here's what matters to the industry that Netflix is in. And a lot of the issues today that the analysts are talking through. So BICO. In addition, there's something called BI. It's right up from BICO. This is the Bloomberg Intelligence main screen where they do industry dashboards. Okay? So if you know your industry, you can search for the industry, or you can click on the menu on the left, and it will be an industry dashboard, which has a lot of data summarized on an industry. So BICO, think of this as the summaries, executive summaries of what's going on at the company industry level. BI, all the industry data. So it's two screens to get a lot of information on. Okay? Screen number 3, BRC. BRC are the analyst reports. And I'm telling you, if you work at JP Morgan, you work at Barclays, you're doing what we're doing. They're having teams that are analyzing the industry and whether it's changing and the competitive position of the companies. This is what they send to investors. This is what's part of the buy, sell, hold opinions. So of the ones that we have access to, JP Morgan wrote something about this yesterday, 2 days ago. Deutsche Bank and Wells Fargo wrote something about this morning. Read those, right? Because they're writing summaries of what's important that are being sent to the investors that are leading to their buy, sell, hold opinions. So you're going to get good insights to your 5 forces here as well. Now, we don't have access to all the research. For example, Goldman Sachs, we're not paying for that, so we don't have it. But we don't have access to Susquehanna, as an example. But we do have access to a few. Now, what matters more is the analyst rather than the company. But the people at JP Morgan are usually pretty smart, and we see their analyst reports. And so, basically you get a sense of that. So BRC. So BICO, BI, BRC. Okay? The final one is off of ELMS. VBIC. Tab on ELMS. This is the university library online. And at VBIC, there is a sub-tab called Industry, and the first item on there is a subscription called IBIS World. IBIS World writes professional 5 forces on industries for a living, paid every 6 to 12 months. So if you click on Industry on IBIS World, you type in the company or industry you're looking for. Slow. There it goes. And then that's in the search across the top. So for example, I type in Netflix. You would type in Lockheed Martin. And these will show you all the research reports that they're in. So for example, I take television production in the US. And then over on the left is kind of the summary of their research report, which they wrote on January 2024 on what's going on with this industry. And what's interesting is if you come over here to, for example, competitive forces, here's the 5 forces analysis and what they say for each one of the forces and the power of the forces. So if you don't know anything about it, you have lots of real world sources to educate yourself. Now, this is very important. And this goes back to the syllabus, and I'm going to say this again on video, okay? We are not Harvard, right? We don't plagiarize. We don't steal other people's work and represent it from ourselves. Matter of fact, the Harvard plagiarism scandal is getting worse every day. More and more people are showing bad research. Those are just terrible academic practices, right? Maryland believes in academic integrity. So here's the point. You are using real world data. You have no choice but to use real world data because you're not going to know anything about many of these companies that we're going to work on this semester, and I fully expect that, which means I expect you to use BICO. I expect you to use VBIC. I expect you to use BRC, or I expect you to read the analyst reports, and I expect you to cite. Okay? So if you want to take a screenshot of this and put it in your paper, source it. If you want to copy and paste from an analyst report, quotations, footnote. If you use the analyst report, bibliography. Those are what are going to be very important for what you're going to have to do, not only for this assignment, but all assignments. So that's the point. A lot of what you're doing, almost like mini research projects, because you're going to be going up a learning curve, learning a lot about all these industries and companies that you probably don't know too much about. And that's okay. And you're going to distill that and put that in your papers with the data that you get, but just source it. Okay? Because if we see a source, then that's not plagiarism. Right? Plagiarism is when you use somebody else's material and you don't source it. So if you copy and paste something, you put a quote on it, that's not plagiarism. If you copy and paste something, you don't quote it, it's plagiarism. Okay? Same thing. I don't care about how you write the bibliography so long as you have one. Meaning, unless about the format, then you just cited something. So for example, bibliography, JP Morgan research report on Netflix. Bibliography, VBIC report on streaming industry. Like, that's what we're going to look for when we differentiate between who's plagiarizing and who's not. But you got to also do the work yourselves. So the final thing is you can't share screenshots. If your screenshot is identical to another screenshot, we consider that plagiarism and you go straight to the Honor Council. So there is no sharing screenshots. You have to get your own screenshots, and you have to basically make sure if you use other work, which you're going to need to, you reference it. Do that, everything will be good. Questions? Which also leads to, even though you're using the same information, you might come to different conclusions. As long as you're explaining your logic, that's okay. And we'll talk about that as we discuss each of the company solutions going forward. Question, or you're just scratching your head? Okay. All right, so questions, comments, crippling fears about anything? Great. Let's talk about the Bloomberg Trading Challenge. By the way, if I were doing Lockheed Martin, U.S. equity, RV, markets, beta, make sure you're using BICs, make sure you don't have global, country domicile, be a different list. Okay? Same thing for your custom comp source. Right? Idea, BICO, they have a BICO. Issues going on, defense and aerospace. BRC, they got a BRC. BI. If I search for Aero, there is the industry dashboard for aerospace and defense. So if I click on industry dashboard, it's literally that. It's all the industry data aggregated from market share, macroeconomic indicators, industry data, company data, valuation, credit, etc. So a lot of this stuff is here. All right, that's why I'm asking you to become BMC certified. All right, Bloomberg Trading Challenge. So the Bloomberg Trading Challenge, which is your first team project, starts today. So let's go back to the teams. This is section 301 under Elms, People, 443. Is everyone now on a team in this section for 301? Is there anybody left that didn't drag yourself to a team? Okay, great. So here's the deal. I need each of your teams to choose in the next 4 to 5 minutes what I'll call the team captain, who at the end of that period, I'm going to register their name as the person to trade on behalf of your team into Bloomberg. Okay? So you meet with your team and basically figure out who you want that responsible party to be. So team 1, you're going to meet in the back left corner there. Team 2, front left corner, my left here. Team 3, back middle. Team 4, middle front. Team 5, back. Team 6, there. Get together, pick a captain, and then we'll go from there. I'll give you a few minutes to work on that. And somebody's handing me the sign-in sheet. Make sure you sign the sign-in sheet if you haven't.
I just checked to make sure.
Please do.
Oh, no, I just the entire time.
One, 2, 3, 4, 5, 6. 5 and 6 are on that side.
Is this your pen? I don't.
Not my pen, but
You want it?
you leave it up here. You sure? Guess someone wants to climb up.
Oh, I just want to let you know that computer right there has some sort of power problem.
All right, I'll mention that to IT.
Okay.
Thanks.
Wait, I'm so confused on the comment.
All right, where's my waitlist student? All right, are you kind of huddling with that team? Okay. Just make sure they don't have more than 8. Go ahead. All right, does everybody have their person? All right, I'm gonna start over here. Team one. See team one? One? Okay. Who's your person? Kyle Wang? Okay. As in Kyle Wang? All right, let's add you. I assume you're this one from Maryland. All right. Team two. Is that how you're in Bloomberg? You're Sam?
Yeah, or it's Sam.
Last name? Again, I assume you're this one, not the Blackstone guy. Team three. Who's your person? Jose. Bill? Find you. Assume you're this first one. Team four?
Pierce, P-E-E-R-C-E.
P-E-E-R-C-E.
And Nozika, N-O-Z-I-K.
N-O-Z.
Yeah.
All right, I'm going to assume that's pretty unique. So, yeah, I'm going to see if I can. It found you. All right. Team five? First name? Jacob, J-A-C-O-B, M-A-R-X.
I mean, it's like 6 weeks.
Okay. And finally, team six?
Liam?
L-I-A-M.
Yeah. And then Wolf, W-O-L-F.
Great. All right, so you're this one, not the Berlin guy. Okay, so your network has been created. There's $1 million of hypothetical money in each of the team captains' accounts. They're the only ones that can access this. Trading competition's officially started. The way that your captain will get here, they'll only get here through Bloomberg, is you type in TMSG. That's the trading competition. When you get to the trading competition, there's a drop-down menu, which you will have the only one in the drop-down menu will be your competition. But as a administrator, I see all the competitions. Okay, so I have to choose a network every time. But even though you're the only one, you still have to choose your network every time. There's only one competition that you will see. So select Spring 30124 for your section. Now, initially, it's going to be blank until you start buying things. When you start buying things, you'll start showing up on this list. Okay? To buy something, you start with $1 million. You're going to click up here called Compose. That's buy. You're either going to go long or short. Right? You're only going to trade equities. Equities are ETFs. Right? Long means I'm buying the stock. Short means I'm shorting the stock. In the first half of the semester, first 6 weeks, you must do at least 10 longs. You got to buy at least 10 stocks. Okay? If you don't buy 10 stocks, you will be disqualified. Okay? Shorts don't matter, so at least 10 longs. Next, the ticker will be loaded of the company that I last was on. So I was already on Lockheed Martin, so it loaded it as if I wanted to buy it. If I want to buy somebody else, put in the company. So let's say that I want to buy Eli Lilly. Okay? It'll load the current share price of Eli Lilly, $648.40. This stuff doesn't really matter. And down here, your network would have already been selected because you only have one competition that you're in. I could buy Lilly in multiple competitions. So I'm going to buy it in 301 Spring 24. And of my $1 million, it says next tick, and that's grayed out because I only allow market orders. I have disabled limit orders and I've disabled stop loss orders. So if you want to buy a company, you have to be logged in during the market to buy it. If you want to sell a company, you have to log in and manually sell it. So if Lilly has bad news, like their biggest product is pulled from the market and their stock is plummeting, until you go in there and do something, your team is just going to bleed money. Okay? That's why your team captain is so important. And you can only do trading at a Bloomberg terminal and their market orders, which only get implemented during market opening hours. So if I buy Lilly at 5 p.m. tonight, it's not going to execute until tomorrow. If I sell Lily at 5 p.m. tonight, it's not going to execute until tomorrow. I also eliminated day trading as an option. Therefore, if you buy it today, you can't sell it until tomorrow. If you short it today, you can't cover it until at least tomorrow. There's a 1-day minimum holding period. Those are my rules, not the system. Okay? And you can't do anything else besides equities. So no options, no commodities, no currencies. But you can do ETFs. All right, so back to this. You start with $1 million. So I'm going to buy Lily, and next rule, you can't put more than 20% or $200,000 into any one stock. Forced diversification. So I'm going to break that rule, and I'm going to buy 300, and I can either type in 1,000 or K if I'm lazy, $300,000 of Lily stock. You put in the dollars you want to buy, not the shares. Okay, it'll figure out the shares. And then when you're ready to buy it, you hit send the market order in. If you trip up any rules, a pop-up will come up telling you which rules you broke that won't let the trade go through. I tripped up 2 rules. Rule number 1, I tried to buy 300,000 and the most I could buy is 200,000, so I won't execute the trade. Rule number 2, I used to make teams write up as a paper all of the reasons they did all the trades all the semesters. No one wanted to write that paper, and I never wanted to grade it. So instead, your real cost of trading is at the time of the transaction, buy or sell, you have to write up a 50-character minimum explanation. That's it. Okay, that's your real cost of trading. The other cost of trading is you get institutional pricing, which is a penny a share. Okay, so you buy 1,000 shares of a company, $10. Okay, that's actually institutional pricing. So that trading fees are not going to be real cost to you, but you do have to explain why. So back to cancel. So make 2 changes. 1, 300,000 is going to become 200,000. And I could just basically talk about Lilly advantage with weight loss drugs. Overtaking Novo, which is Ozempic. And now I'll send it in. Okay, so like I said, it doesn't have to be long explanations, but at least 50 characters as to why. All right, so now I'm on the screen because I just bought something. All right, I got 1 long when it's executed, but you'll notice it hasn't executed yet. What time is it? 3:07. So the market's still open, so it'll probably execute today, but it's actually going through real bids and asks. So it's going to go through the trading system in Bloomberg and try and fill the bids and asks to fill your market order. So that's the other thing. If you have a very thinly traded stock, it may not execute $200,000 betting on the company you're buying. I don't think it had trouble with Lilly, but it might take a few minutes before it shows up. Okay? Now, I'll show you what it looks like from last semester. This is section 401 last semester. They didn't liquidate their portfolios in December, so it's kind of keep tracking through today. You're going to be judged on portfolio value. Everybody has $1 million today based on the trades you make. That is how we're going to keep score. Okay? So in 6 weeks, team in first place, A Ortiz, gets 5 points. Team in last place, I Wei, gets 1 point. Everybody else in between. 5, 4, 4, 3, 2, 1 will be the point distribution. And we're set after 6 weeks. All right? This is all you'll see in terms of the competition. You won't be able to see other people's trades, but you'll be able to see your own. So if you want to see what did the winning team, which had a 17% return, buy with their 16 trades, this is what they owned. Okay? So as you buy it, it'll give you how you're doing on each stock, but only you will see that. The other teams won't see anything more than your total. And you'll see only the teams in your section. Questions about that? All right, if you want to know the rules, so for example, in an earlier section today, section 101, one of the teams already bought something. I bought, who did I buy? NVIDIA. And you can see by the end of the day, I've made $700. So again, I'll give you real-time tracking of your portfolio. If you want to see the rules, go up here to settings, rules that I have set. Okay, I've kind of summarized a few. But number one, market trades, next tick, only during market hours. 50 characters to buy and sell. Auto closing, which means limit orders, I've disabled. So there's no limit orders. Have to put no more than 20% of your portfolio in one stock, forced diversification. 10 trades over the first half of the semester, no less than $10,000 in a stock. All right, you can't put like $100 in a stock. You got $1 million. It's not enough. So minimum $10,000. A few other restrictions. I did not restrict regions. So pretty much you can buy a stock anywhere in the world. All right, you know a lot about London, you know a lot about Tokyo, Hong Kong, feel free. You don't have to just invest in US companies. All right. Trade limits. I have set a limit that says you can't do penny stocks. So no trading in microcaps has to have at least 500 million of market cap to buy or sell it or short it. And $3. So no penny stocks. So if it's less than $3, you can't buy or short it. Now, if you short it at 4 and it goes to 2, you can cover it. All right, but you can't buy more at 2 if you bought it at 4. Okay, so period restrictions, minimum holding period, 1 business day. Buy today, can't sell it until tomorrow, and penny a share commissions. Those are mainly the rules, right? Again, the only person that can access this, TMSG, is the captain that was just registered. They'll trade and see your performance on behalf of the team, all right? 2 last things. 1, when you get in here and you look at your portfolio, you see that circle red X? That means I can sell, okay? So basically, if you want to sell, click on the circle red X. Before the time you're allowed to sell, it won't show you circle red X, but that's how it's called, closing the position, closing the idea. Finally, there is another feature in Bloomberg. It's called W, worksheet. It's not part of the trading competition. You'll learn about this in your BMC certification. Create a new worksheet. You can either do a blank one or you can use one of these templates. I would say equity, buy side, or sell side. I'll choose the sell side template. Create. It's like Excel in Bloomberg. What you do is you start picking companies. So today, I bought NVIDIA. I bought Walmart. I don't count. Where's this now? All right, try this again. Ticker, Walmart. Oh, why is Bloomberg doing this to me? Anyways, try a different one. W. When it works, give you an example here. Here's a worksheet that I have. Type in a bunch of ticker symbols, like here's NVIDIA. Try this again. Click. WMT, and we just bought Lilly. So this is going to kind of track these companies in real time, and it's got some of the sell side template. What's interesting is you can actually customize this to have any data point you want, from analyst recommendations to earnings estimates to target earnings dates to whatever, and it'll be on the screen. Okay, here's what I'd recommend. The person that's managing your captain, that you can't see what they bought, but they can mirror the portfolio here, including adding a column for original price paid. So you can kind of see what your performance is here. When you click on this, you can share it, put in the Bloomberg accounts of your team members, and anybody on your team can see the portfolio in real time. I would recommend 2 worksheets. 1 for the ones you bought, 2 for ideas. So worksheet trade ideas, share it with your team. So that way, for the rest of you that aren't trading, and you're going to meet like once a week or whenever you talk as a team, here's the companies I think we should buy or sell. Put them on the worksheet, just as a suggestion. Don't have to do it, but that's the other way you can track the competition. Questions about any of this? Yes.
Going back to the descriptions of like the buys and sells, is it 50 characters or 50 words?
50 characters. It's a sentence. But here's the last restriction. 10 longs over the 6 weeks. By next Wednesday, you have to have less than 300,000 of cash. You got to be at least 70% of your portfolio invested by next Wednesday. If at any point after next Wednesday, you have more than $300,000 in cash, I'll give you a warning. Second time I say it, you'll be disqualified as a team. Okay? So you must trade. You can't stay in cash. It's a trading competition for equities. Doesn't matter what happens in the market, buy equities, sell equities. That's all you can do. Yes?
Is it market close Wednesday or beginning of class Wednesday?
I'm going to look at it during class Wednesday, and then I'll give it to the end of the day if I have to warn anybody. So just buy something, buy at least 5 companies by Wednesday. You can do more than that if you need to. Questions? All right, you got homework 2, due Monday 10 a.m. Trading competition started today. Make sure you sign the sign-in sheet. Have a good week. Remember, TAs have office hours next 2 days if you need help on your assignments. Take advantage of that as well.